This is the Times Television Network, and you're watching ET Now.
Hello and welcome to Talking Technicals. Today we're going to look at some really important momentum indicators. These indicators have the ability to foretell market moves, i.e. they have much better predictive powers than moving averages. And we will focus on tools like rate of change, that's ROC, and relative strength indicator, RSI, with our expert on the show, Dr. C.K. Narayan. Well, Doc, momentum indicators essentially measure the acceleration or deceleration. So, if you're looking at a car and you're looking at the speed of the car, the speed is moving up very quickly. We know that the car is going to pick up speed. And the same way, sharply rising stocks, of course, indicate that there is a large upturn on the horizon. Is that a fair way to look at it?
Yeah, I think the example of a car is a good one. You see, the car is a static body which moves ahead when we impart some sort of acceleration to it. In a very similar manner, the stock is also a static body, and what we do in the market is actually give it some acceleration, either by way of money, which is demand, or by way of stocks, which would be supply. So all prices are as a result of supply-demand equation, and what we are really giving with the supply-demand equation is some amount of acceleration or momentum. So it's very clear that momentum has to precede movement, which is why any sets of indicators like ROC, RSI, etc., which are based on momentum principle, will actually precede movement in the prices. Right? See, let me illustrate it with one example here. What I have here on the chart is the momentum indicator of ROC. This is the price plot here, and this is the ROC plot at the bottom. Now what we see here is as the prices go higher, so does the momentum plot. Here, this is a very typical plot of momentum, where in the initial portion you will have increasing momentum, but in the later portion of the price rise, you will actually have momentum sort of slackening off. But then as long as the plot remains above this white line, which is like a neutral line, we say that the momentum is on the upside direction, and which is why the prices are heading even further higher. So the momentum plot will always precede prices and help to sustain them.
Right, and that's what they say, market mein tezi hai. We were talking about basically momentum out there. Alright, rate of change is what we were talking about, and essentially it's what it means. It's the rate at which the price of a stock changes over a fixed period of time. So if you're looking at, say, 10-day ROC and the value is 10%, it essentially means that the price has moved up 10% on a 10-day comparison. And similarly, minus 10% means that the price has gone down by 10% over that particular time period. Any ROC number, Doc, that people need to keep in mind?
Well, in the case of momentum, it's all sort of direction play. The more the momentum, the more the move is likely to last, and further that move is going to sort of ensue. What most of the momentum indicators will actually do is set up a kind of a peak or a trough, which is visible here on the chart. If you notice here, as in when the market actually reaches the levels out here, you actually form a peak in the oscillator, and very similarly at these low levels it actually forms a trough in the plot of the set of oscillators. So these are the levels that we look at as being overbought or oversold. Now the area which we had in the previous chart marked as the peak and the trough are the ones which we actually call as the overbought zone or as the oversold zone. The overbought and oversold zone, as you rightly explained, are areas where the market has lesser tendency to keep going in the same direction. So when you reach the overbought zone, it is actually a warning from the market that this may be temporarily overdone, and therefore if you go long the stock at overbought zone, you are actually taking a larger risk. Similarly, if you were to look to short in the oversold zone here, the market is again saying that you are actually selling into very weak areas, and there is a chance that the market can actually rally from there, and you would get a better chance or a much better price to sell into. So overbought, oversold zones are very critical areas which can be measured from any oscillator.
How do you decide where that band actually starts? Is it specific to a stock, or is it just specific to a number on the y-axis?
It will actually be very, very specific to every stock, and within the same stock also it could actually change. Now if you look at here, this is the chart of Nifty at say sometime during the earlier part of this chart, you actually see it going to a significantly higher level, but over here it sort of slightly short of that same level. So within the same chart also you will have areas where it will overshoot, it will have areas where it will be seen at around the same level. So you can't really pin it down to an exact number. It will be more of an area of overbought and an area of oversold. Some of the stocks could become overbought at, let's say, 5% away from the mean. Other charts wherein the trend is very strong could keep going till about 8 to 10 odd %. But very typically you will find that it will not exceed more than 8 to 10 odd %. So if you keep that as a band, you have a rule of the thumb or a working sort of percentage.
Right. So that's with ROC. There are many momentum oscillators that we look at. There's another important one called RSI, or Relative Strength Indicator. What this one does essentially is compares the strength of the prices on the up moves with the prices on the down moves. So we've seen ROC, Doc. Let's look at RSI on the charts.
See, RSI is a very similar indicator like the ROC. But it's a much more widely accepted, much more widely used, because it's a fairly robust kind of indicator. Now the overbought oversold is very clearly seen in ROC. The key thing that you get to see in the RSI much more clearly is the divergence pattern, which is what I've shown on the chart. We had discussed divergence briefly in the last episode. Just to recap, the divergence is a pattern when the prices are moving to a new extreme, but the indicator is not moving to a new extreme. So you actually have a divergence in the plot patterns between the price and the indicator, which is what you see here. Here I have used the RSI to signal a buy. What you see in the prices is that the prices are actually dropping down to a new low, which I have shown here with a downward sloping trend line, which is connecting the two new lows. If you come down to the level of the RSI, this is the plot of the RSI, the magenta line, you will find that the corresponding lows of the RSI plot actually create an upward slope in the trend line, meaning that the new low in prices is not being accompanied by a new low in the RSI plot. In the RSI, this divergence pattern is very well, it's very, very clear. You can see it very well. So if you want to spot divergences, I would say RSI is the ideal oscillator that one should use. So once you do have a setup like this, which is a divergence, and you have a trend break which is out here, that is where your signal to buy actually emerges. Okay, here I have a chart of the Nifty in order to illustrate, let's say, a sell signal. We had looked at the buy signal earlier. In the drive up on the Nifty actually makes a higher high out here in the prices, which is visible and which I have marked with an upsloping trend line. If you go down and look at the same set of peaks which actually correspond to these highs and prices, you will find that the RSI is actually set up a lower peak even as the prices make a higher peak. This is what is known as a negative divergence, and this is what sets up a sell signal based on the RSI. Then we draw a trend line to indicate a price break, which is a change in trend. As soon as we have a change in trend, the divergence signal is confirmed to be a sell signal, and we could then take a trade.
And if you had to make a trade on this, would you make it when the stock price actually cuts the trend line?
Yes, you should wait for the change in trend signal, because this thing, otherwise some of the problem areas related to oscillators will actually kick in, and maybe it will give you a little bit of trouble.
Okay.
But to avoid that, we actually add in the trend element.
Time now for a short break, but let's see what you remember of what we spoke about and discussed last time, and that was about the moving average convergence divergence line. So here's an easy quiz for you. I'm sure you will all get it. MACD is the line that depicts, and you have out here a couple of options. You need to pick the right one. MACD depicts either the addition of two moving averages, B, does it depict the difference of two moving averages, and C, does it depict the rate of change of two moving averages. So that's three options for you. Figure out which is the right one, and we'll tell you the answer when we come back after this.